We got a lot of good content coming up. This is a very interesting small panel that I put together. Rick Heitzmann, I'm going to say a few quick words about it. I met Rick just recently personally. I was at an event in Los Angeles and he yelled out, "Hey, blockchain Lindzon." And because I changed my Twitter handle to blockchain. And it kind of startled me because I forgot that was my name on Twitter. I don't really know much about the blockchain, but I had changed my Twitter handle. And that's
Bitcoin was at 18,000 at the time.
No, was it? And so Rick got me. I just told him today why I changed it. I was worried that a lot of my LPs may judge me based on having a weird Twitter handle. So thank you for that. That was good advice. Anyways, Rick has made some incredible investments over the years. He started his firm, First Smart Capital, which has how much under management?
A little over $1.5 billion.
So just over $1.5 billion. So a significant amount of capital. And next to him is a good friend of mine, John Frankel. And John is on how many funds now? He's on Fund 5. He is a longtime Goldman partner on the trading floor. He was here last year. And he's an investor in StockTwits as well. And knows a thing or two about trading, the future, and trends. Today I just want to talk about trends. Rick, give us a little background, we have time, but a little background what got you interested in investing and your path to VC.
Yeah, I was an entrepreneur. I founded a business called First Advantage, which is very different from what I do today. It was early days of data and the beginning of the internet, of being able to digitize information about people, background screens, credit screens, drug screens. We took that company public and sold it for over $1 billion. So I got involved in the entrepreneurial company creation process, and I loved it. So that kind of led me to then starting a firm and getting involved with entrepreneurs at the earliest stages. So that was fantastic.
And what was the first taste of it? Was it an angel investment that, while you were a CEO, or was it? Did you get?
I was a venture capitalist before. Actually, went back further. I was doing distressed buyouts out of college, and really thought about, hey, where are people making good decisions and bad decisions as managers and investors? And it was dealing with the bad buyouts of the late 80s when high yield first started, buyouts started. Some was good, more is better, like most booms. Then it was a disaster, and I was one of the people called in to pick up the pieces, so you understood good and bad decisions from that perspective.
Okay, got it. Now, John, just a little bit of background from your mouth again, your start, and a little bit about FFVC.
Well, I was on the... Yeah, can you hear back there?
Yep.
Okay. So I was an equity research salesperson at Goldman, and 99 was just a crazy period, and I thought we'd never see anything like that again. I think this ICO craze that we've seen is the closest thing. And despite all the restrictions on the Goldman trading floor, I was able to make a decent amount of money. I was up about tenfold in 99. And I looked around and said, everything is high beta. Where can I get alpha, not beta? Where can I not have a daily mark to distract me? And so I started angel investing. And in fact, my very first investment was in a company called Theatermania. I put $24,000 in. And they were sold last year. So when you think about day trading versus venture, that was a 17-year venture investment.
Do you remember your very first trade or investment? What got you into the markets?
Into venture?
No, what got you into just your first trade, or what got you on the path to Goldman?
What got me on the path? That's a long story.
But did you like the markets naturally, or did you just get a job?
Were you a kid reading the...
No, I wasn't the kid who... I did trade some stocks as a kid, but no, it was really... I got into Goldman. I was previously at Arthur Andersen, which is an accounting firm. I looked around and said, I don't like what the partners do. I think it's a boring job. I don't think they're necessarily the most stimulating people I want to be around. So I looked around, and there was this, in London, there was this firm called Goldman Sachs that had an opening. And no one I knew who they were, and I just sort of joined them, and I thought I'd be there for 2 years, and it was a rolling 2 years. Ended up being 21. I did about a dozen jobs at Goldman through the back office and the front office, and ended up on the trading desk for the last 11 years there.
Got it. Do you, Rick, do you think it pays, can you be bearish on the public markets and bullish on what you do, or do you go through moods where you're like, let the markets decide? When you have $1.5 billion and it's real money, it's different if you have, like for us, we manage 50 million in a fund, and we're not macro thinkers. Do you have to think more macro now that you're bigger?
Actually not. You can think macro because you have expectations where you're always going long. So we don't have to make a ton of investments, but we make 10 to 15 investments per year. And we try and say, we're not picking macro trends. We're not deciding where the market's going to go. We're going to make the best 10 or 15 investments we see this year. And definitionally, we're long. We're going to be in these investments 5 to 10 years. So regardless if this is a hot market, not a hot market, hot sector, not a hot sector, we invest in sectors we know, in the best companies, hopefully at a slight discount to market, because we have a bit of a brand we could leverage regardless of market conditions.
And what about you, John? Because you're a trader, or you worked on a trading floor?
Look, as I said to you, I gave an example of a 17-year cycle. I mean, we didn't know what the exit market was going to look like 17 years forward. So I think the public markets ebb and flow based on beta, multiples expand, contract, the economy does what it does. We're investing on secular themes. So, we're spending a lot of time today around AI, cybersecurity, drones, and robotics. And there's small plays in the public markets you make around those themes, but we think those areas will be much bigger sectors as you go forward. Just as, when we were looking at social networks back in 2008, 2010, there were maybe small plays in the public markets, and they're much bigger sectors today.
Okay, so Rick, let's take apart StubHub. And what is when you saw StubHub, was it the team, was it the market opportunity, was it a combination? So their firm did StubHub. Walk us through how that worked.
So it was just the market opportunity in early days of marketplaces, and we've invested in subsequently a bunch of marketplaces from StubHub to Upwork to Airbnb, and we just thought that's kind of a pure use of the internet of discovery, fractionalization on both sides. People could put on supply, people could put on demand, and it could fundamentally change markets. So StubHub, as a kid who loved going to games and could rarely afford them, I was always looking for that arbitrage. How could I get a ticket that maybe even be below market to go to a game? So I knew that market. But before StubHub, you'd go and you'd see, Fat Bob in the back of the bar who had a gun, some cash, and some tickets, which may or not be real, as a ticket scalper. And could this be a better experience? And then interestingly, and John alluded to it, a lot of our markets are zero market size when we first invest. And when we did the investment in StubHub, we thought it was around somewhere between $1 billion to $2 billion market.
The whole market?
The whole market, because you couldn't figure out, because all these guys were sketchy, not even brokers, sketchy scalpers.
It was local
very
local.
It was guys that, some of the guys don't even know. Guys kind of whispering under their breath, walking around Madison Square Garden. And we thought, hey, we could probably
I do that, and I'm not selling tickets.
Yeah, I've heard that. So how do you figure out what the size of the market is? And just, to make a long story short, we thought it was $1 billion or $2 billion market. StubHub's transaction volume now is, I want to say, 12 or 14 billion. So 10x that, not even all the market.
All right, so we'll get into that. That's the magic of trends in the sense that they blow, I don't know if they call it umbrellas or like what Uber did, where they break through and increase the market size. So what's the market size of tickets now?
It's about 35 billion.
So so really what makes a winner is not just picking the team, it's that the whole market expands.
And you look at Uber in San Francisco is twice as big as what the taxi market was in San Francisco, regulated, controlled 5 years ago. So they've just, and that doesn't include Lyft, doesn't include Chariot, all that other stuff. So they've increased the size of a market 10x by creating a better product in that right market.
Fascinating. All right, so I want to get into how we can make money going forward. Let's talk first with John. So do you watch the public markets to pick up things, or do you look at the private markets to look at public markets? I know they're connected, but where do you see the future? Is it robots? Is it AI? Where are you focused?
I mean, so a couple of things. You know, I've been in this business long enough that when I was first at Goldman, we actually had mainframe terminals dotted throughout the building, and then we had client server, and then we had the internet, and then mobile a decade ago, and today it's AI. Now, what's interesting, as well as AI, you could have quantum computing, voice, blockchain, which is, well, you're named. That's how you were christened. As well as AR and VR. All of these are technology shifts that can unlock a lot of value. So we try to look a little bit forward in that regard, and AI, we think, definitely sort of passes that test. And then we look at human behavior. And I think there's two fundamental things about human behavior. We heard some of that earlier when we talked about Tinder. People just want to have fun, right? If you have an interface that's boring and 6 clicks, or one that's fun and 2 clicks, you know which one's going to win every time. And by the way, 1 click is better than 2 clicks, and not having to click because it just knows what you're going to do is even better. And we're moving in that way. And people want it to be really seamless in what they're doing. And so you look at the activities that people do, and you look at the companies that come in, and you go, do they lean into that? Or do they ignore that? And if they lean into that, it gets our interest. And so within FinTech, which I think is in the title here somewhere, we're seeing consumers, millennials predominantly, but not just millennials, who are confused. These products are opaque products, they're complex products, they try and bury the fees in places, they try and make it difficult to get from A to B. And we're seeing FinTech consumer-facing products that are simplifying the process, where you can sign up for insurance on your mobile phone, where you can get loyalty points simply by just shopping places without having to sort of do anything extra, where I mean, at some level, what StockTwits does today is bring community into this mobile experience. And I think this simplification combined with helping people understand what they're doing is absolutely the right direction. So we've got a number of investments around that part of FinTech. And then the other aspect is, and this is mentioned on the last panel, we've gone from not enough information to drowning information to now having AI that can predict how we want to use that information. And so there's just pushing that curve forward of your news that you need, finding you, is a phrase that Fred Wilson has used. You don't find news, it finds you. But actually having a trusted agent on your shoulder who says, look at this is interesting, this correlates, you should do something. That increasingly is going to be what people will expect, look for, and just become the basic bar.
Okay, excellent. Rick, same question. So you're stewarding a little more money than most. Is there a theme that you're looking at?
I think a lot of the things that John mentioned, things that we like to do are things that seem just to make sense, right? So we'll continue the StubHub analogy or the Airbnb analogy of, hey, would you rather, or Uber, hey, it's raining out today. 10 years ago, you'd sit in the rain out there, you'd be soaked, trying to run after and flag a cab. Isn't it almost like magic? You could push a button, a car comes, picks you up, you don't get rained on. That's great. Isn't that just a much better experience? And then you look at Uber's numbers are going like this. Those are obvious things that as a consumer you feel, as intellectually that makes sense. There's a business model that makes sense. And it's not only you, but if you look at the numbers, there's 1 million other people who are having that same experience.
Okay, Facebook. We all have our opinions. Is this good for tech? Long term, is it like when you watch the news and now you invest?
The data experience.
Yeah,
Or-
is that good for startups? Is it bad for all of tech that is it changing how you're thinking about what you do?
I generally think it's bad. So if you think about Facebook is over 50% of all the audience on the internet, and Facebook and Google, I think, are a little over 70% of the ad dollars, and they're net taking share. So everybody not named Google or Facebook is net losing digital dollars. So that's bad for technology and advertising technology, marketing technology, everywhere around that. But as we know, that those guys get stronger and stronger until they don't, and that walled garden will eventually crack. But in the interim, it chokes off a lot of startups and chokes off a lot of innovation.
And John, thoughts on the Facebook scandal in general, not so much whether who's right and who's wrong, just what it does to our industry.
I think it's probably irrelevant. We'll have to see, but I suspect that a month from now, maybe 3 months now, we've moved on and talked about something else.
Okay. And is there a company in your portfolio that has you that you're allowed to talk about that really gets you excited? And what is it about the product and company that you like? And how is it tied to a public competitor or somebody bigger?
There's only one right answer.
No, John can't answer. This is the questions to Rick first.
StockTwits. Just because it's, I'll use an approachable example that some of you might know, so it might be a good mix. But Hubble, the direct-to-consumer contact lenses, falls in that thing of seems to make sense. So contact lenses, very expensive, sold through your ophthalmologist today. So very confusing process, layers of supply chain, layers of costs, that Hubble is able to sell you the same lenses direct to consumer at 50% off by acquiring you directly, have a digital native relationship, having a subscription product, which is great for both your customer experience and their economics. And they control the supply chain because it's a medical device. So therefore, they're not dealing with every asshole who wants to sell you contacts. They have moats around their business. So from a consumer perspective, it's a example in a non-technology but more approachable way of how they're creating business, how they're creating value for everybody in the supply chain.
So when did you see the company?
I saw it right after it launched. I did the A, and I did an extension.
Is it a New York company?
New York company.
Okay.
It's probably the fastest growing consumer subscription product ever.
Okay, so this is where I talked earlier, if you were here, about Amazon, that all these micro brands are death by 1,000 cuts. Or not death, I mean, it's not hurting Amazon, because Amazon will obviously at some point have the right to buy a lot of these companies. But so now it's growing. So now what's the worry? What's the worry of a company? Who are they looking at that can sue them? Like, who's their headache as they go higher?
Headache is how do you build shoulders off that product? So what are the adjacencies and how they matter? As we think about commerce, there's things we like, things we hate. One of the things we hate is the weight of water. You don't want to pay to ship water around because no one wants to pay for shipping. It destroys your margins. So how does that company expand? They're already in 8 countries. Could they grow products? And therefore, how big could that company be? And although whether it's Walmart with Jet and maybe Flipkart or some other companies that are willing to pay a high multiple, when you get over the $1 billion mark, it's awful hard for companies that trade at single digits times earnings or EBITDA, all the big conglomerates, the Colgates, the Unilevers, the P&G, to pay, multiple times revenue. So are you stuck in a kind of an exit trap?
Okay, so that's important because it goes back to P&G, which is being pummeled relentlessly, and we could argue it's interest rates or Amazon or the U.S. dollar being weak, but there's Hubble.
There's always guys
quietly,
taking shots. Everybody's taking a shot.
Everybody's
in every piece of their business, they're taking a shot. So what do you think about P&G, Colgate, Amazon, Flipkart, all over the world? If you're trying, I talked to the guy who runs innovation at Colgate, who's a very good guy if he's watching here. But he ran toothpaste in India, is where you got to start in Colgate. Trying to build relationships with bodegas in India. That's super hard. If you have Flipkart, like that's, Flipkart's going to deliver that same toothpaste immediately. And if it's not Flipkart, it's, blockchain's toothpaste that's willing to deliver it to you in an hour next week. And that whole business is getting disrupted.
Wow. Okay, John, same thing. Is there a company outside of anybody in this room that, or something that gets your firm or that you see as electric, and who is it? Who do you worry about in the public markets? Like, what's the next stage?
Yeah, so, this question is always difficult because a lot of companies we invest in are not consumer facing. And so they become very sort of abstract and niche, and to talk about them in an audience here becomes tough. But I'm going to talk about a company out of San Francisco we invested in called Dashbot. And Dashbot is an analytics platform for chatbots. And their sort of KPI they look at is the cumulative number of messages they process. So they have one line of code, 2 lines of code, that if you have a chatbot, you can drop it in, and then you get analytics back. Just as going back a decade ago, Google for analytics, you drop a line of code and you get it back for your web page. And we believe that chatbots, conversational interfaces, are on a big, long arc, even though any given chatbot may have a short half-life. And so, we looked at them back in November 2016. That's when we first invested. And they have processed life to date just shy of 200 million messages. And by April last year, they crossed 1 billion. So, they're growing like 50% year over year.
Are people finding them? Is that what happens? People find them?
They're finding people. They have community managers. People are finding them. And, the number's out of date because they're growing quite rapidly. But last time I looked, they crossed about 31 billion messages. So they're doing about 3 billion messages a month. And they're 10 times larger than the next person. So we like them because it's a winner-take-most market. They're putting in all of the pieces necessary to create unfair advantage for them. And, it's still so below the radar. And yet, think of, I'll give you a sense. Facebook a year ago said that their whole platform was doing about 21 billion messages a month. And these guys today, a year later, are 1.5 times the size that Facebook was back then in terms of messages across the platform.
So you see what's going on the ground level. That's why it's hard for me to be bearish in general. Something that we always, for 10 years, have thought about at Stocktoberfest is like it's easy to technically think about the S&P, but underneath at the belly, there's so many thousands of companies getting started, and the umbrella is getting bigger. So with that in mind, to end it, the markets in general, like, do you care about them? Do you think about them? The S&P? Do you need it to be bullish for you to do well? I mean, do you need it to go up for you to do well?
I love the markets just as, as a kid, watching Louis Rukeyser on my dad's lap. That was great. No one gets that except the guys on the stage. That's okay
I used to watch it.
But, so I like the markets. I'm interested in the markets. Definitionally long, so I need the markets to at least be stable or go up or have the disruptors go up. As I talk to people from different lines of investment management, everybody feels their asset class is expensive, but at the same time, everyone's seeing assets being, pieces being disrupted, and everyone's seeing legacy businesses fail. So there's not only the value shift, I think, is almost as important to me as the total market size.
And forgetting politics, something on page 6 that could hurt the market that no one's talking about? Is there something that you guys in your weekly, I assume you have weekly partner meetings, is if it were to come up, what is something that you worry about that no one's talking about? All right, I stumped him, but there is something.
It would probably be something that would say, hey, someone's never going to make money. Or we've looked at Amazon, and after pulling apart, someone got the detailed elements of Amazon's business, and they realized that if they extrapolate it out 30 years, you're still implying a 5,000 times PE in 30 years.
So that's a good answer.
And therefore, you can never really justify businesses that have very, very low earnings today.
Yeah, people call, Whitney just said Bitcoin zero. It's like, really the risk is, to me, I've always said that, it was like, if Amazon really wasn't real, The market would go.
Something's not real. Everybody, people decided, this Facebook thing's stealing my data. I'm moving to another platform. And therefore, whether it's Facebook or Twitter or Snap or anyone who has network effects in their business, that people wake up and say, hey, those network effects aren't real. That there's much more.
So low likelihood then.
I would say low likelihood, but all black swans are low likelihood.
So it's a black swan, and that's a real black swan. John, let's let you talk about the markets a little bit.
I think similarly. If you go back to the 70s, there was this big investment in solar, and then it sort of burnt off. We've had in AI.
No pun intended.
Yeah, we've had AI winters and the like. You now got this whole question around Tesla about can it actually be an economic model, just not a model for social change. So, I worry that we're in year 9, 10 of a 6-year bull market, and at some point we're going to have a bear market, and I don't think a millennial's seen a bear market where things don't just work, where, a lot of things that people said you do it naturally doing this are actually very cyclical and not secular. And those downturns are kind of depressing, and I don't think we've banned them. So that concerns us, just generically.
One last question. Have you ever been scared? Like, has the markets ever scared you, or you're like, oh, fuck, the business
Oh, yeah.
may not work?
I was running a company on September 11th. That just, our sales were down for that month 94%. Like, it was just, I don't know if there's even a way, I don't know if there's even a light anywhere. But, dawn came. But, and I also, you also in 08, 09, where, you have smart people saying, Dow 1,000, or, there's no way that the Dow is never going to get to 10,000 again. And if you're an idiot, you're only an idiot if you think it's going to get to 10,000. And this is going to be a long unwinding of the debt cycle. And, it was a couple months.
And so, a couple months, okay. And the world, maybe that's the black swan that we don't have the lights stay on. So for you, being in Goldman, was there a moment where you were like, oh fuck, things aren't going to work? I guess 9/11, but like other than 9/11.
No, 9/11 was traumatic, but I remember '87, and the markets were different; they were more physical. But one of the senior trading partners for Goldman and one of the senior trading partners for Salomon Brothers walked onto the floor of the stock exchange and said, both of our firms are willing to put $1 billion of capital at risk. And that stabilized the market. And, today we have markets which are dark pools and electronics and increasingly run by machines. And if we hit an 87, I don't think there's anyone to walk on a floor that doesn't exist to stabilize it. So, that's a risk that's out there that we all kind of know, that the markets one day could just stop.
Well, like, and on that, you're all screwed.
That positive.
I think a few people are selling, but I really appreciate you guys taking the time.
That comment was just after the close.
Oh, we closed? All right, who cares? All right, everybody. So up next is a break. All right, let's drink.
Drink coffee with trade ideas.